What if I told you there's an ETF paying out roughly 14% a year, backed by the biggest tech companies on the planet? Sounds too good to be true. So let's break down whether QQQI actually is. QQQI is the NEOS Nasdaq-100 High Income ETF. It launched in January 2024, and in just over 2 years it has pulled in more than $9 billion in assets under management. It even won Best New Active ETF at the 2025 ETF.com Awards. The pitch is simple. You get the Nasdaq-100, the index that holds Apple, Microsoft, Nvidia, Amazon, and the rest of a big tech. And on top of that, the fund pays out a monthly distribution that has been running near a 14% annualized yield. Most savings accounts pay 1 or 2%. So how does QQQI do it? The answer is covered calls. QQQI owns a basket of Nasdaq-100 stocks. Then every month the managers sell call options on the Nasdaq-100 index. A call option is a contract that gives a buyer the right to buy at a fixed price. The buyer pays QQQI a premium upfront, and that premium is the cash that gets distributed to shareholders. Here is what makes QQQI different from the older covered call funds. The options it sells are on the index itself, not on individual stocks. That triggers a special tax rule called Section 1256, where 60% of the gains are taxed at long-term rates, even if the contract only existed for a month. For investors holding QQQI in a taxable account, that can be a meaningful boost. But here is the catch. A 14% distribution yield is not the same as a 14% return. The fund's actual SEC yield, the part that comes purely from dividends and interest, is barely zero. Most of the cash you see paid out is option premium, and a chunk of that is technically classified as return of capital. Return of capital means part of the distribution is your own money being handed back to you, which slowly eats into the fund's net asset value over time. There's a second catch, and it shows up in strong markets. When tech rips higher, the call options QQQI sold get exercised against it. That caps how much upside QQQI can capture. So in a roaring Nasdaq year, you collect your fat monthly check, but you watch QQQ leave you behind on price. Performance-wise, QQQI has actually done well. Since launch, it has produced annualized total returns above 20%, which is impressive for an income fund. But that result happened during one of the strongest tech runs in history. In a flat or choppy market, the math gets less generous, and in a bear market, the option income only softens the blow rather than preventing it. So who is QQQI actually for? It is for investors who want monthly cash flow from their portfolio without selling shares. Retirees, income-focused accounts, or anyone who values predictable distributions over chasing maximum capital gains. It is not a substitute for owning QQQ if your goal is long-term growth. The honest reality is this. QQQI is one of the most successful new income ETFs in years, but the headline yield needs context. You are trading future upside and some NAV decay for big checks today. If this kind of income ETF deep dive helps you, hit like and subscribe. And drop a comment with your take. Would you trade Nasdaq upside for a 14% monthly check, or stick with plain QQQ? I read every reply.